Look at the chart on your screen right now. Not the price, not the numbers, not the candles. Look at the line. That massive vertical line exploding out of the top of the candle. That is not just a wick. That is a crime scene. Silver didn't walk to that level. It didn't climb there step by step. It teleported. One moment, price was sitting calmly near $79. The next moment, it flashed to $83.71. No warning, no buildup. And just as fast as it appeared, it vanished. The floor disappeared. Silver collapsed from $83.71 all the way down to $74.47. That's a $9 swing in a single trading session. Let that sink in. $9 in hours. If you are new to this market, you are probably terrified right now. You are staring at that red candle thinking, this is it. The rally is over. The bubble just popped. But if you've been here before, if you survived 1980, if you lived through 2011, you know exactly what this was. This was not a crash. This was a stop hunt. A deliberate, calculated, algorithmic attack. And today we are going to break it down piece by piece. Silver did not drift to $83. It didn't grind higher. It didn't discover price naturally. It jumped. That alone tells you everything. Markets that move naturally do not teleport. Teleportation only happens in thin liquidity. And today, liquidity was gone. This is Ghost Week, the final week of the year. Desks are empty. Traders are on vacation. Order books are hollow. The banks saw this days in advance. They saw volume evaporating. They saw gaps forming in the book. And they knew one thing. If price moves into a vacuum, it can be pushed anywhere. So they let it run. They allowed silver to rip higher, straight through resistance, straight into the headlines. $83 sucked in retail money like a vacuum cleaner. The FOMO crowd arrived. The late chasers arrived. The over-leveraged arrived. And then the trap snapped shut. To understand the crash, you have to ask a simple question. Who was buying at $83? It wasn't smart money. Smart money bought at $30. Smart money bought at $50. Smart money built positions quietly. The buyers at $83 were emotional. They were chasing. They were using leverage, 10 times leverage, 20 times leverage. They weren't investing. They were gambling. And here's the part most people don't understand. The banks know exactly where gamblers hide. They know where the stop losses sit. Most traders who bought above $80 placed their stops at $75. That wasn't a guess. That was a data point. So here's what happened next. At the highs, the banks sold a massive block of futures contracts. Not slowly, not carefully. They dumped. Price slipped from $83 to $79, then $78, and then it entered the danger zone, $75. Snap. Thousands of stop-loss orders fired simultaneously, automatic sell orders, forced liquidations, margin calls. This created a waterfall, a cascade of selling. Silver didn't fall because investors changed their minds. It fell because machines forced people out. The price plunged to $74.47, and waiting patiently at that level were the same banks that sold at $83. They sold high, they forced you to sell low, and then they bought it all back. This is called rinsing the leverage. It's ugly, it's brutal, and it's how markets cleanse themselves. Now let's talk about the candle itself. Technically, today printed a shooting star, a small real body, a massive upper wick. That wick represents rejection. The market tried to go to $83. Sellers pushed it back. This does not mean the bull market is over. It means the market went too far, too fast. Think of it like sprinting uphill. Eventually, you need to stop and breathe. We should expect consolidation, sideways action, chop between $75 and $80. The market just consumed a $9 move. It needs time to digest. Here's the number almost nobody is talking about. Last Friday's close, $71.91. Current price, around $78. Despite the crash from the highs, silver is still up nearly 10% from last week. Ignore the wick. This was a huge green week. The trend is still up. The breakout is still valid. What changed? Only this. The easy money phase is over. Now comes volatility. Now look at gold. Gold is sitting calmly near $4,514. Down a few dollars, no panic, no collapse. This matters. Gold is the anchor. If silver were truly broken, gold would be crashing too, but it isn't. Gold is telling us the monetary system is still unstable. Silver is just the high beta version of gold. It overshoots, it exaggerates. That volatility is the price of admission. When silver dropped from $83 to $74, something interesting happened. Physical holders didn't panic. Coin shops didn't slash prices. Dealers didn't dump inventory. In many cases, premiums rose. That tells you everything. The paper price collapsed. The street price didn't. Why? Because physical dealers know the paper market is broken. They refuse to sell real metal into fake volatility. The dip existed for minutes, and even then, inventory vanished instantly. This was a paper event, not a physical one. Low volume creates air pockets. That's why price fell so far so fast. There were no buyers in the middle. Silver fell until it hit real demand. Where? $75. That was last week's breakout level. Old resistance became new support. Technically, this was perfect behavior. Whales were waiting there. They bought aggressively. That's why silver snapped back to $78. Imagine you're the procurement manager for a solar company. You need silver. You saw $83 this morning and panicked. Then you saw $74. You didn't panic, you celebrated. You locked in supply. Industrial buyers used the crash as a gift. That buying pressure is why price rebounded so violently. This wasn't retail buying. This was structural demand. Volatility is a tax on leverage. If you were trading futures or options today, you paid the tax. If you hold physical, you paid nothing. Your ounce is still an ounce. In fact, you gained information. You now know the market is capable of hitting $83. That flash was a glimpse of the future. It showed where price wants to go when suppression slips. Think of silver like a beach ball underwater. For a moment, the grip slipped. The ball shot to $83. Then the banks wrestled it back down. But now we know how much energy is stored. $83 isn't the ceiling, it's the preview. This crash actually helps January. If silver went straight to $100, the correction would have ended the bull run. By flushing leverage now, the market reset. Pension funds don't want to buy $83. They're happy to buy $78. This rug pull made silver more attractive to institutional money. Textbooks say shooting stars are bearish. Context matters. A shooting star at the end of a long trend is dangerous. A shooting star at the start of a breakout during a holiday vacuum is a speed bump. This was a liquidity test. $83 found sellers. $74 found buyers. Now the range is defined. We have 2 days left in the year. If silver closes above $75, it will be the highest monthly close in history. That prints a massive green candle on the yearly chart. Daily noise doesn't matter. Monthly structure does. Right now, the bulls are winning. Here's what you do next. 1. Audit your leverage. If today made you sick, reduce risk. 2. Watch $75. That's the fortress. 3. Ignore intraday noise. Ghost Week is designed to shake you out. Today was violent by design. It was meant to scare you. You survived it. You didn't sell the bottom. That's how bull markets are won. Silver woke up in 2025. In 2026, it goes to work. $83 isn't the top. It's the target. The bull is alive, and it's angry. Subscribe.